Meta committed $14 billion to Scale AI weeks before Scale AI exposed private AI training data from Meta, Google, and xAI through unsecured Google Docs. That sequence matters more than either fact alone, because the investment thesis rested on Scale AI as a trusted data infrastructure partner, not a liability vector. The consensus reading of the $14 billion deal was straightforward. Meta was locking in proprietary training data pipelines ahead of rivals, converting Capex into a competitive moat no smaller player could match. What the breach inverts is the directionality of that moat argument. The same vendor concentration that was supposed to insulate Meta's models now becomes the single point of failure for its most sensitive training assets. The training data that leaked included material tied to Meta's own AI development, which means the breach did not merely embarrass a vendor, it reached the intellectual property layer that justified the investment premium. Institutional holders who priced the $14 billion deal as a moat-building move are now holding a position whose thesis changed character before the ink dried on the agreement. The position pressure shift here is not from the headline itself, but from the implied vendor audit that follows. Every large-scale AI training contract now carries an implicit due diligence cost that was not priced at signing. Meta shares fell 1.4% on the day the layoff restructuring broke, trading at $602.61 against a prior close of $611.21, but that move preceded full market digestion of the breach disclosure. The $14 billion figure is the checkoff anchor for this entire analysis. It is the number that either validates or indicts Meta's AI infrastructure thesis, depending on what the vendor dependency structure turns out to be. If the breach resolves as an isolated configuration error with no model weight or proprietary pipeline exposure confirmed, the moat thesis survives, damaged but not structurally broken. The invalidation condition is not the breach itself. It is whether Scale AI retains Meta as a primary data partner after an independent security audit, or whether Meta must diversify vendor exposure at a cost that dilutes the return math on the original $14 billion.
The 10% headcount reduction and simultaneous redeployment of 7,000 employees into 4 AI divisions is not a cost-cutting story. It is a signal about where Meta believes the marginal return on human capital now sits. Consolidating AI functions into 4 named organizations means Meta is reducing coordination overhead between the data, model, infrastructure, and product layers that previously operated across separate reporting lines. That structural compression matters to capital allocation because it shortens the feedback loop between training investment and product deployment, which is precisely the metric that justifies a $200 billion Capex commitment to the market. The Guardian reported that transfers into AI roles are not optional, which names the position pressure change underneath the headline. Meta is not asking which employees want to work on AI. It is removing the organizational optionality that allowed non-AI functions to compete for headcount budget. Participants who read the layoffs as a margin expansion play moved first. That is the trade the sell-side coverage telegraphed when framing the restructuring against Meta's Q1 2026 revenue of $56.3 billion and earnings per share of $10.44 against a $6.66 estimate. But the institutional capital that has not yet repositioned is the cohort pricing Meta as a social media compounder rather than an AI infrastructure operator. Those two valuation frameworks carry different multiples, and the reorg forces the reclassification. The risk the reorg introduces is execution. 7,000 involuntary transfers into a new function while simultaneously absorbing the reputational fallout from a vendor data breach creates a talent retention pressure that does not show up in the EPS line for at least 2 quarters. If attrition concentrates among the AI researchers and data engineers who were voluntarily working on model development rather than among the reassigned employees, the reorg's efficiency thesis inverts before the Capex returns materialize. The threshold that confirms the reorg is working is not headcount stability, but model release cadence. If Meta's next major model update arrives on the previously communicated timeline despite the restructuring, the organizational compression held.
Meta's $200 billion AI data center commitment is the largest single infrastructure bet in the company's history, and its return logic depends on one assumption the breach just made visible: that the training data feeding those data centers is secure, proprietary, and competitively inaccessible. Scale AI is not a peripheral vendor in that chain. It sits at the data labeling and curation layer that determines model quality, which means its security posture is directly load-bearing for the return thesis on the $200 billion. The breach exposed training data for Meta, Google, and xAI simultaneously, which produces an asymmetric information problem. Meta now knows its data was exposed, but does not yet know how much of what was exposed has been accessed, copied, or incorporated into competing pipelines. That uncertainty gap is what differentiates a recoverable vendor incident from a structural thesis break, and it is the gap that institutional capital cannot price until Scale AI completes an independent audit. CoreWeave, which carries a $99 billion backlog and scored a significant Meta infrastructure contract, represents the alternative capital pathway. If Meta shifts compute purchasing toward vertically integrated providers with audited security stacks, CoreWeave's positioning improves at Scale AI's expense. The participant timing asymmetry here is that CoreWeave holders already moved on the Meta contract news before the breach disclosed the vendor concentration risk that makes that contract more strategically urgent, not less. Meta's WhatsApp opening to rival AI chatbots from OpenAI and Anthropic, reported the same week, adds a countersignal. If Meta is distributing access to its own distribution infrastructure, the proprietary data moat may matter less than the distribution mode. That reframe does not rescue the $14 billion Scale AI investment. It merely relocates where Meta's competitive advantages claim to live, shifting it from trading data quality to platform reach. The $200 billion Capex commitment remains the terminal test. If Meta can demonstrate that its data center build-out produces model performance measurably superior to rivals who did not make that bet, the breach becomes a footnote. If the models converge toward parity despite the Capex gap, the entire infrastructure thesis, Scale AI included, demands revaluation at the multiple level. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.